We have been conditioned to treat our credit score like a high score in a video game. If you hit 800, you win. You are financially responsible. You're officially part of the successful American middle class. But in 2026, the credit score is not a measure of your wealth. It is a measure of your profitability to the banking system. Welcome to the Credit Score Gamification Trap. Today, I'm going to show you how Wall Street turned debt into a psychological game, why paying off your loans actually hurts your score, and how the system uses this 3-digit number to keep you trapped in the working class forever. To understand how the trap works, you need to stop looking at your score like a consumer and start looking at it like a bank. Banks do not care how much money is in your savings account. FICO does not look at your net worth, your income, or your investments. They only look at one thing: your relationship with debt. Let's look at a day in the life of an average American. We will call him Mike. Mike makes $85,000 a year. He's a hard worker. He wants to buy a house, and he checks his Credit Karma app every single morning. Mike is terrified of his score dropping, so he plays the game exactly how the institutions designed it. He gets an email saying he is pre-approved for a new rewards credit card. He takes it because the blogs told him that having more available credit lowers his utilization rate. Then, his car lease ends. Instead of buying a cheap used car with cash, Mike takes out an 84-month auto loan. Why? Because the dealer told him that having an installment loan will mix up his credit profile and boost his FICO score. Mike's score goes up to 780. He feels like he is winning. But let's look at the math. To keep that high score, Mike is now paying hundreds of dollars a month in interest. He is funding the bank's profit margins. Now, let's look at Mike's neighbor, David. David hates debt. He pays off his mortgage 10 years early. He pays off his car and cuts up his credit cards. He has $200,000 sitting in a high-yield savings account. He is completely debt-free. What happens to David's credit score? It drops. It plummets. Within 6 months, David might not even have a measurable FICO score. Why does the millionaire have a worse credit score than the guy drowning in monthly payments? Because the credit system was not built to reward financial independence. It was built to identify and reward the most reliable, profitable borrowers. If you don't borrow, you are useless to the system. When a bank looks at your credit file, they are running a risk-based pricing model. They divide the population into transactors. If you have a score below 600, you are a subprime risk. The bank expects you to default, so they charge you 30% interest to cover their losses. You are playing the game on hard mode. If you have a score of 800, you are what the industry calls a transactor. You pay your balances in full. Banks actually do not like you very much. They call you a deadbeat behind closed doors because they do make any interest off you. Only merchants swipe fees. The bank's favorite customer is the person sitting right in the middle, the 680 to 720 range. They call these people revolvers. Revolvers carry a balance month after month. They pay the minimums. They occasionally miss a payment and get hit with a late fee, but they never completely default. They are terrified of losing their access to credit, so they will skip buying groceries just to make sure their credit card payment clears. The entire gamification of the credit score, the green arrows, the congratulatory emails, the push notifications is designed to turn you into a revolver. They want you confident enough to borrow, but stretched just thin enough that you can never pay off the principal. In 2026, this gamification has become a trap, because everything from auto insurance premiums to apartment rentals is now tied to your credit score. You are forced to play the game. If Mike's score drops, his car insurance goes up by $50 a month. His landlord demands a higher security deposit. So, Mike does whatever it takes to keep the score high. He keeps the credit cards active. He takes out the personal loan to consolidate debt, only to run up the credit cards again a year later. He is chasing a high score in a game where the only prize is the privilege of borrowing more money. He is trading his actual liquid wealth for a digital reputation score managed by 3 private corporations that have been hacked multiple times. So, how do you survive this system? You have to decouple your ego from your credit score. You play their game, but you play it defensively. You automate your finances so that the credit algorithm is satisfied, but you refuse to pay a single cent of interest. Rule number 1. Treat credit cards strictly as debit cards. If the cash is not already in your checking account, you do not swipe the card. You set up auto pay for the statement balance in full every single month. You extract the points the cash spike, and the fraud protection. And you give the bank nothing in return. Rule number 2. Never finance a depreciating asset just to build credit. You do not need an 84-month car loan to get a good mortgage rate. A perfectly managed credit card and a history of on-time utility payments are enough. Stop playing their game for a high score. Start playing for your own freedom. The bank is not your friend, and your FICO score is not your net worth. Protect your cash, build your assets, and let the algorithm do whatever it wants. If you're ready to stop feeding the fractional reserve system and start building real wealth, hit subscribe. This is month 2 of the financial reset. I will see you in the next video.